This voice is taken from an article with the title, "What is the significance of the 51% attack threshold in cryptocurrency?" which has been published on TraderTalks.net. A 51% attack is an attack on a blockchain network where a single entity or group of entities, e.g., miners, obtain control of more than 50% of the network's mining power or computational power. This type of attack is a major concern for most public blockchains, as it allows malicious actors to gain control of the network and double-spend coins, prevent transactions from being recorded, and perform other malicious activities. The 51% attack threshold is significant because it is the threshold at which a single entity can take control of the majority of the computing power on a blockchain network. This type of attack is particularly dangerous because it allows the malicious actor to control the network, manipulate transactions, and double-spend coins. By controlling the majority of the network's computing power, the malicious actor can also prevent other miners from mining or validating blocks, thus creating a monopoly and allowing them to censor transactions. This type of attack can be prevented by utilizing decentralized consensus algorithms such as proof of work, (POW), and proof of stake, (POS). In POW, miners compete against each other to solve complex mathematical puzzles in order to validate blocks and add time to the blockchain. In POS, miners must stake a certain amount of coins in order to be allowed to validate blocks. In both cases, it would be very difficult for a single entity to gain control of more than 50% of the network's computing power due to the distributed nature of the consensus algorithm. In addition to utilizing decentralized consensus algorithms, cryptocurrency networks can also implement other security measures such as transaction fees, network sharding, and network forks. Transaction fees help to incentivize miners to validate transactions and thus reduce the likelihood of a 51% attack. Network sharding helps to divide the network into smaller pieces so that it is more difficult for a single entity to gain control of the majority of the network. Finally, network forks allow the network to reset itself in the event of a 51% attack by reorganizing the chain and discarding any malicious blocks. By utilizing these security measures, cryptocurrency networks can mitigate the risk of a 51% attack and ensure that the blockchain remains secure and resilient.